Okay, everybody, it's 3:55. My name is Jeff Ulmer, and I'm going to be presenting this last section. So I'm between you guys and a cold beer or a glass of wine. So we'll try to get through this. I see we got a few more people joining in here. We'll give them a minute. So while we're waiting on everybody, just a couple reminders. Please mute your microphones and please use the survey to fill in your questions. And you have to be here for the entire presentation to get your CPE, and we will be giving out the words as we go. And with that, we will get started. So first thing we're going to do is go over some business tips and ideas for the end of 2020. Some of these things have been mentioned in earlier sessions, whether or not you guys have attended those or not, but they are definitely worth repeating. You might want to consider the bonus depreciation for 2020 asset purchases. By doing so, it allows a 100% write-off for foreign purposes for new and used property now. And keep in mind, for Virginia and several other states, there is an add back for that bonus. And one nice thing about with the bonus depreciation, you can wait and make that election up to the time your return is filed, waiting to see if there's going to be any tax law changes for 2021, or in case you think your tax rate's going to increase. The CARES Act that came out this year corrected the old TCJA error that now allows for 100% bonus depreciation for 15-year qualified improvement property that was mentioned earlier. And this applies to the qualified improvement property that was placed in service in 2018 through 2022. One of the requirements is that property must be put in service after the date that the building was first placed in service. So you can't buy or put up a brand new building and then have qualified improvement property as part of it. You have to buy the building first or have it built first and then put in the qualified improvement property later. The qualified improvement property is an improvement to an interior portion of a non-residential building that is not an internal structure or framework of the building. It does not enlarge the building or is not an elevator or escalator. And like before, taking bonus, you may want to consider not doing so if you think that the tax is going to increase in the future. For bonus depreciation, there is a retroactive refund. And it can be recaptured by amending returns for 2018 or 2019, or you can reflect the additional retroactive deduction entirely in the year 2020 with an accounting method change. So I think that depending upon how much you have and how cumbersome it will be, it may be simpler just to go back and amend the 18 and 19 returns. You can also take bonus depreciation for a heavy SUV, pickup, or van. The requirements there are the vehicle must be used more than 50% for business, and the vehicle must have a gross vehicle weight rating of over 6,000 pounds. And that GVWR rating can be verified by looking at the manufacturing label that's found on the inside edge of the driver's door. The IRS also has issued a list of qualifying vehicles on their website, and they break it down by year. And just as a aside there, you want to be careful because sometimes, depending upon the year of manufacture, some of the vehicles are over 6,000 pounds and some of them don't quite make it. So be careful there. Another idea is to take advantage of the more generous Section 179 deduction rules. For 2020, the maximum is 1.04 million. Advantage here is there's no add back for Virginia returns for taking 179 expense. The CJA allows 179 expense for personal property used to furnish lodging. Examples of that are furniture, kitchen appliance, living quarters, equipment, and such. And what qualifies as lodging is facilities or hotels, motels, rental condos, apartment houses, and single-family rental homes. And the TCJA also expanded 179 expense for certain equipment related to real property, and that this applies to non-residential buildings. Examples of that are qualified expenditures for roofs, HVAC equipment, fire protection and alarm systems, and security systems. And like the QIP rules, these assets must be placed in service after the date the building was first placed into service. One thing you want to be careful of is the 179 expense limitations for pass-through entities. They may get hung up coming through and not be able to be deducted on the individual level and have to be carried over. Cost segregation benefits. These cost segregation studies allow you to allocate building costs to tangible personal property to accelerate the depreciation lives versus longer lives for commercial real estate of 39 years and residential real estate of 27 and a half years. By doing so, that tangible personal property can be depreciated over lives of 5, 7, or 15 years, and those assets are eligible for bonus. One thing to keep in mind, the tangible personal property related to real estate is no longer qualifies as part of a 1031 tax-free exchange. So you might want to take in consideration this. I realize it's down the road if you're going to sell the property, but if you think you might want to be exchanging if you're moving up, as it will, to just get bigger and larger properties, you might want to consider not doing the cost seg study so that you can 1031 exchange the entire property. Another idea is to time income and deductions for tax savings. Unless the rates are going to increase in 2021, deferring income and accelerating expenses makes sense if you will be in the same or lower tax bracket. Another idea is to accelerate income and delay deductions if you think you're going to be in a higher tax bracket for 2021. And for C corporations, the CARES Act has increased the charitable contribution limit to 25% of taxable income. The old rule was only 10%. Another idea of tax savings for corps is deferring taxable income. If the entity uses the cash basis method of accounting, you can manage the business taxable income over the 2020 to 2021 period. One of those ways is to use a credit card to charge expenses. You claim the deduction in 2020 because you charged it, but you don't have to pay the bill until 2021. Another idea is to mail checks for bills a few days before year end. The expenses are deducted in the year you mail the bills, and they won't clear the bank until the following year. Another idea is to prepay expenses for the next year as long as the economic benefit from the prepayment doesn't extend past 12 months or the end of next year. Next, consider waiting until the last few days of the years to send out invoices to customers, thus delaying payments received until 2021. And if you think you're going to have a higher tax rate in 2021, you just kind of want to reverse everything that we just talked about. I failed to mention, if anybody has any questions, if you can just put them up there in the chat or raise your hand, I'll try to switch back and forth and look over there every once in a while to see if there's anything come up. Another idea is creating or increasing the net operating loss. And it was mentioned before with the new acts that came out, NOLs that were incurred in 2020, 2019, or 2018 can now be carried back 5 years. So if you expect your tax rate to be higher in future years, you might want to make the election to carry forward the NOL to future years to get a more benefit and more tax savings. You can get a quicker refund by filing a tentative refund claim, but it must be filed by 12/31/20 for the 2019 calendar year. If you anticipate a loss for the 2020, try to file your tax return early because you can't claim the NOL carryback until the return's been filed for the year. Another tax saving is selling qualified small business stock. Qualified small business corporation stock is stock that's been acquired after September 27, 2010 and held for more than 5 years, and that can qualify for 100% gain exclusion. The definitions for qualified small business stock are hard to meet, so not many corporations may benefit from this break, but if you want to talk to one of us in the tax department, we can help you go over those definitions. One thing to note is this benefit is not available to C corporations that own qualified small business corporation stock. Another idea is to maximize the QBI deduction for pass-through entities. The deduction currently is allowed through 2025. Deduction can be up to 20% of the pass-through owner's QBI. The deduction phases out at higher income levels and is based on the owner's taxable income. And just be aware, note that tax strategies at lower taxable income may have a negative side effect by also reducing the QBI deduction. So you kind of, as you're doing your tax planning, you want to decide which one will give you the most tax advantage. Another idea for businesses is establish a tax-favored retirement plan. In current retirement plans allow for significant deductible contributions. If you're a self-employed individual, you can set up a SEP IRA and contribute up to 20% of your self-employed earnings. If you're employed by your own corporation, up to 25% of your salary can be contributed to a SEP IRA. The maximum for 2020 is $57,000. Other plans are available for entities. It's 401k plans, a defined benefit pension plan, and a simple IRA. And depending upon your circumstances, these plans may allow for a larger deductible contribution. Plans must be established by the end of this year, so you have a short time frame to do so. The only downside is a simple IRA had to have been established by October 1st, so that's put out of the wayside there for that, but it's something to plan for next year. The contribution deadline for putting funds into these retirement plans is the extended due date of your 2020 tax return. Another planning tool is to accelerate AMT refunds. And the TCJA eliminated the corporate AMT tax and allows entities to claim their unused credit on 2018 through 2021 tax returns. The CARES Act came out and allowed corporations to claim all the remaining credits either in 2018 or 2019. So in order to do so, corporations must file the Form 1139 by 12/21/20 to claim the AMT credit this way. So we basically have 4 days left to do that. For the business interest deduction, make sure that the interest expense is paid up by year end, because that allowance now has risen for 2020 to 50%. And the allowance reverts back to 30% for the calendar year 2021. Let's see, Matt Hale brought up a question. Can you give some examples of qualified small business corporation stock? Are there any key elements we should look out for? couple of them are that you have to buy the stock. It has to be an initial offering, and it has to be a C corporation. Those are the two big ones. There are some other ones in there as well. And like I said before, they're kind of in depth. So if you get in touch with me, I can help go over those with you. Another item is the de minimis safe harbor election. It's a good idea to make this election for new businesses and then any other old businesses that have not already done so. This election allows a business to deduct small dollar items up to $2,500 per invoice without audited financial statements that would otherwise have to be capitalized. And this is can be very advantageous to companies, either small or large. This was mentioned before in earlier one of the sessions. If you were sitting in on it, that talked about the nexus based on the COVID-19 telecommuting, and certain states have issued specific guidance on whether telecommuting employees temporarily working in a state due to the impact of the pandemic creates corporate, excuse me, income tax nexus for an employer who does not operate in that state. Currently, Alaska, Colorado, Michigan, and Montana are the only states that will impose this nexus. Amber and Mark had in their presentation, and you can refer back to the slides, had a list of states that said that they were not going to impose nexus. And then I think there's about 15 states that have not said one way or the other or whether they're going to do it. So just keep on the watch for that. President Trump declared all 50 states and DC and the 5 territories disaster areas due to COVID-19. And what this means is that every U.S. business is covered and may be eligible for refunds from certain types of disasters. Excuse me. The provision may potentially affect losses arising in a variety of circumstances, including the loss of inventory, supplies, or the closure of offices, stores, or plants. And to qualify, the loss must actually be attributable to or caused by the COVID-19 and satisfy several other requirements. Here again, rather than going into detail on that, if you see one of us, we can help you with that. Okay, we've come up to our first attendance code, and it's the word good. I'll give you a second to write that down. Next, we'll talk about some individual tips and ideas. It was mentioned earlier as well, if you attended one of the sessions. There's an above the line charitable deduction now, and that is taxpayers can claim a $300 charitable deduction. And the only caveat there is the contributions must be made in cash and must be made before the end of the year. Some of the taxpayers and our clients have received stimulus checks. The checks were issued to taxpayers for $1,200 per taxpayer and $500 per qualified child dependent under age 17. These payments were based on 2018 or 2019 return information, dependent upon how soon you filed your 2019 return, and may not match what is actually going to be calculated on the 2020 return. If the 2020 credit calculation is less than the check amount you received, there's no credit clawback, meaning you don't have to pay the money back. And if you received less than the credit that was calculated on the 20 return, it can be claimed as an additional refund. One thing to watch out for, since particularly for people that were laid off or had their wages cut back, is there might be some income tax withholding shortfalls. And you want to make sure that your withholdings and estimated taxes align with the tax that you expect to pay. And in some cases, the shortfalls can be made up through additional withholdings on year-end salary or a bonus check. And the way you want to do it through the bonus in that is because withholdings are considered earned ratably throughout the year, thus helping to reduce the underpayment penalties. And if you can't do that, you'll have to use the estimated tax payments, and you might have to pay a little bit of underpayment penalty. But there again, you could probably use the annualization method and to reduce that to as low as possible. Another opportunity for tax planning for individuals is the opportunity zone investments, and that was also mentioned earlier today. There are more than 8,000 opportunity zones, and many types of investments, developments, and business activities qualify. In some scenarios, not only can you defer paying taxes on the gains invested in the opportunity zone until as late as 2026, but you can only recognize 90% of the gain if you hold the investment 5 years. If you hold the investment for 10 years and satisfy certain rules, there's no tax on the appreciation of the opportunity zone itself. And I think Kendra said that you could see her, and also we could refer back to her slides for more information on this. Capital gains, if you can, you want to take advantage of the 0% long-term capital gains bracket. And that can shelter up to $40,000 for singles, $80,000 for married couples, and $53,600 for heads of households. And those capital gains are long-term capital gains and also qualified dividends. And the strategy is, if you have investments with losses to recognize in 2020, consider selling investments with capital gains to offset these losses, and then do vice versa so that you end up with either a net effect or a capital gain. It says gain stocks that are sold can be repurchased without being subject to the wash sale rules. And a few items here related to the sales of cryptocurrency is keep in mind that the exchange of cryptocurrency for another cryptocurrency is treated as a sale, unlike if you're trading one currency for another, such as like a U.S. currency for the euro or something like that. And some virtual currency exchanges may not provide investors with documentation to substantiate the sales, gains or losses. Therefore, it's up to the investor to keep detailed records of all transactions. For itemized deductions, medical expenses for this year are allowed only to the extent they exceed 7.5% of AGI. State and local taxes are still limited to no more than $10,000. Mortgages and interest is deductible up to the extent of $750,000 of mortgage debt unless it's grandfathered, and then the limit was $1 million. No deduction is for home equity loan is allowed for home equity loans unless it's used to purchase improvements or in addition to the principal residence. And it also must be secured by the principal residence, the equity line. And miscellaneous itemized deductions are still not deductible. A personal casualty and theft loss are deductible only if they are attributable to a federally declared disaster area. And even then, they're subject to a $100 deductible and a 10% of the AGI threshold. So chances are, unless you had a real big casualty loss that wasn't covered by insurance, you're not going to get any deduction. For charitable contributions, an idea is to consider it a qualified charitable distribution. This was mentioned earlier as well. And for taxpayers over 70 and a half, you can give up to $100,000 per year to a public charity other than a DAF. The distribution is not taxable and the contribution is not deductible. So that's the trade-off there. Also want to consider bunching charitable gifts to allow for itemized deductions in 1 year as opposed to be stuck with the standard deduction each year. So you can plan to give maybe 2 or 3 years of charitable giving in 1 year if you have the funds to do so. Giving to a donor advised fund allows you to take a charitable deduction in the current year for the entire amount, yet you can delay the actual gift giving out of the DAF for later years. Again, that goes back to that second point about bunching up the charitable contributions. The CARES Act, excuse me, came out and allowed for charitable contributions up to 100% of AGI for 2020. The requirements there is the contributions must be made in cash and they must be made to a qualifying charity under the IRC 170B1A rules. Excuse me. And also to do that, an election is going to be required on the tax return. For retirement accounts, there's no required minimum distribution for calendar year 2020 under the CARES Act. If a taxpayer had taken an RMD prior to the CARES Act passage, excuse me, they're allowed to roll over this distribution, including any withholding. The Secure Act increased the required minimum distribution age from 70 and a half to 72 for individuals that were born after July 1st, 1949. Excuse me. I'm losing my voice here. I think I'm catching a cold. The Secure Act also allows for contributions to traditional retirement accounts for people to continue after age 70, and this is a good planning tool for individuals that are still working. Also consider maxing out on your deferrals on a 401k and any other retirement plans to reduce taxable income and maximize your retirement income. Some plans allow for a catch-up contribution for those that are 50 years or older. The CARES Act came out and allowed individuals under 59 and a half to withdraw up to $100,000 from their retirement funds for COVID costs without incurring the 10% penalty. Excuse me. And if the funds are paid back within 3 years, the income tax can be avoided. If an individual doesn't feel that they can pay the funds back, the tax on the withdrawal can be spread over 3 years, beginning with the 2020 return. And this, just a reminder, this should be considered a last resort after all other options have been exhausted in order not to maximize your growth on your retirement distribution. Net operating losses, like the business returns, an NOL that was generated in 2018, 19, or 20, excuse me, can be carried back for 5 years. You may want to consider waiving the election carryback period if you anticipate your income in 2021 to be higher or if the tax rates might increase. And this election can also be, you can wait to make this election until you file your tax return. So if you file your tax return later in 2021 and the rates have gone up, then that election can be made. The CARES Act also eliminated the 80% limitation on those losses. Depreciation planning, just refer back to the earlier part of my slides there for the on the business returns. Another planning ideas for disposition of passive activities. You may want to consider getting rid of passive activities with suspended passive losses to reduce the current year taxable income. By doing so, the losses that are in the year of disposition can exceed other passive income for the year since they are no longer considered passive. There have been some changes to the kiddie tax. The Secure Act reinstated the kiddie tax rules that were previously suspended by the TCJA. Unearned income of a child is no longer taxed at the same rates as estates or trusts. And taxpayers can amend their 2018 or 2019 returns. And that may be a good planning opportunity if there was significant tax in those years due to the higher rates. Another planning tool for individuals is 529 plans. You may want to consider maxing out the contributions to the state 529 plans. Contributions to Virginia plans are allowed as a deduction on the state income tax return, subject to certain limits. For taxpayers over 70, there is no limit to the amount that can be deducted on the Virginia return for a 529 plan. And finally, up to $10,000 can be used for educational purposes for a beneficiary that is enrolled in a public, private, or religious elementary or secondary school. Mortgage interest rates. You may want to consider refinancing before the end of the year while the interest rates are low due to the current economic trends. I checked a couple of days ago when I made these slides. The 30-year loan rates were around 2.5 to 2.875%, and 15-year loans rates were around 2.3 to 2.525%. Other factors to be considered are closing costs, cash out, and the length of term that you want. So it may or may not be advantageous to go with a lower rate depending upon what your current rate is. But most of these websites have little programs that you can run to see how much savings you'll have depending upon if there's closing costs or to compare the rates. Planning for gift and estate taxes, year-end planning. The prevailing view is that the current lifetime exemption amount is probably going to be as good as it's going to get, and using it up before it's gone might be your best bet. For 2020, a person can give $15,000 per person for an unlimited number of people without having to file a gift tax return. And this amount increases to $30,000 per person if they elect to gift split with their spouse. The downside to that is that doing that requires a gift tax return to be filed. The lifetime gift exemption for 2020 is $11.58 million per individual. And you might want to consider accelerating gifts in 2020 to take advantage of the lower valuations due to the pandemic, thus preserving some of the lifetime gift exemption for future years. Oops, wrong way. State conformity, as was mentioned before in one of the sessions earlier today, some states, and the number of that is growing, do not conform to the most recent Secure and CARES Act as well as earlier legislation. And while some provisions of the CARES Act apply retroactively for federal tax purposes, they may not at the state level. And for those of us in the office and those of us that are guests, if you ask us, we can provide you with some state conformity charts from our tax research services of BNA and RA. Okay, we come up to the second attendance code, and that is bad. And you probably can guess what the third one's going to be. Okay. 2020 tax planning under President-elect Biden. We're on the home stretch, which is good because my voice is about on the home stretch too. Obviously, one cannot predict what's actually going to happen with the new Congress, but there are some highlights which has been proposed during his campaign. What he's done is he's proposed to increase the income tax rate for corporations to 28% from 21%. I think this was mentioned earlier too. There would be a new form of corporate AMT tax that would require corporations to pay the greater of the regular corporate income tax, or a new 15% minimum tax on worldwide book income of $100 million or more for entities that did not pay any corporate or federal income tax. Related to FICA taxes, there's a proposal to remove the cap on the wage base for Social Security taxes for individuals making over $400. And this would mean that there's going to be a donut hole between $142,800, which is the new wage base for 2021, and $400,000 before the Social Security tax kicks back in. Excuse me. Biden has proposed a 10% Made in America tax credit for companies that create jobs for American workers. And this will be available for revitalizing, if someone revitalizes a closed or nearly closed facilities, retooling or expanding facilities, and bringing production or service jobs back to the U.S. and creating U.S. jobs. For estate taxes, Biden wants to reduce the lifetime exemption to $3.5 million per taxpayer, and then increase the top estate tax rate to 45%, which is currently now at 40%. And he also wants to eliminate the basis step up on the date of death and alternative dates, meaning that the next person in line is going to carry on with your original tax basis. And finally, he's proposed the lifetime gift exemption would be reduced to $1 million. And as I mentioned before, both of those are currently $11.58 million. So I think we mentioned it also. It's a good idea to get rid of it now while you can. But I believe that probably what's going to happen is, and it's been talked about before when on these estate taxes and that, is that things will be grandfathered in. Another one of his ideas is the top individual rate would revert to 39.6 for taxable incomes above $400,000. And the capital gains rate would increase to the top rate for taxpayers with taxable income of $1 million or more. So that means that anybody below the $1 million would still have the 3, 0, 15, and 20 rates. Biden would eliminate the carried interest rules and the 3-year holding period required for long-term capital gain losses for certain service-based partnership interests. And the qualified business income deduction would be phased out for individuals making over $400,000. And he would also end the special qualifying rules, including those for real estate investors. So therefore, you wouldn't get any deduction. He's proposed to limit the itemized deductions for individuals earning over $400,000 would have a cap of 28% of the value of the deductions. And he would also reinstitute the P's limitation, which is that 3% haircut on itemized deductions for taxable incomes over $400,000. One good thing is he wants to get rid of that state and local tax limitation of $10,000. He wants to expand the child and dependent care credit from a maximum of $3,000 in qualified expenses to $8,000, or $16,000 for multiple dependents for children under 13. And then the credit would also become refundable. And the reimbursement rate would increase from 35 to 50% for families making less than $125,000 a year. He's also proposed to increase the child tax credit from $2,000 to $3,000 for children ages 6 to 17, and would allow another $600 bonus credit for children under 6. This credit would also become fully refundable, and the additional credit would start in 2021 and would go for as long as the economic conditions require. So it does have, I guess, some type of sunset feature if the economy improves. He also wants to reestablish the first-time homebuyers tax credit for up to $15,000. And with his plan, the credit would be paid upon the purchase of the house rather than waiting to file the income tax return. So it sounds like it might become part of the closing. He wants to expand the earned income tax credit to older workers. For student loans, he's proposing that they would be canceled and tax-free after borrowers have been enrolled in the income-based repayment plan for 20 years. And for, for retirement plans, Biden wants to create an automatic 401k plans for workers without access to pension or 401k plans. And is also wants to offer tax credits to small businesses to offset much of the cost of starting and maintaining retirement plans. The last attendance code, I think I'm going too fast, is unknown. Give everybody a second to write that down. So do we have any questions? I don't see any hands up or anything in the chat. Yes, Victoria, I thought it was going to be ugly too, but I thought unknown would go with my presentation. Though some of Biden's plans are kind of ugly, I would submit that. Any other questions, comments? What's y'all's thoughts on
I think
Biden's
there's a hand
plans?
raised.
Yeah,
Jeff,
whoever raised their hand, go ahead. I can't see it.
Yeah, Jeff, I had a question, and I apologize. I had to look away for a few minutes. You might have covered it, and I just missed it. But I've heard that they also have a provision where they're going to limit the value of deductions at the 28% bracket. Is that?
Yeah, that's what they talked about with the itemized deductions are going to be limited to 28% of value. So that's and that's for people making over the 400,000.
Okay. Yeah. Thank you.
Sure. Oh, Chris, you got your hand up? I see it now.
Yeah, I just had a quick question about the estate taxes.
Yeah.
And he wants to reduce the lifetime exemption to 3.5.
Right.
Is there any thoughts on there what that might actually end up being if they do try and change it?
Well, I think if it does go back, most likely what will happen is that, they would have like I said before, they would be grandfathered so that anybody that's already given more than the 3.5s, there wouldn't be any type of, additional tax or clawback or anything like that. But, it just going forward, that's what the amount would be. I mean, practically in everybody's administration, there's even been talk. I think in Obama wanted to go back to the original 600,000, but that didn't happen. But here again, I don't think that there would be any type of clawback. It'd be a grandfathered thing, or from this date forward type law change.
Gotcha. Yeah, I was just wondering because it's a pretty. I know it used to be at like 5, I think, when I was in school, and now it's at 11. Now he wants to drop it down to 3. It just seems like a lot of jumping around.
Yeah. Well, I think they're he's trying to figure out, and that's, since everybody's amassing their income, that's the way to get it back. And another big kicker there would be the the elimination of the step up in basis. I mean, that's a huge thing.
Gotcha. Thank you, Jeff.
Sure. Anybody else have anything? Questions, comments? Well, thank you for attending. Make